This is one of the most famous trading indicators ever created, and today we're going to find out how to use it and the best strategies and settings. On top of that, I'm going to explain in a simple way the sometimes confusing topic of divergences in the RSI, and how you can apply that knowledge to increase your success even more. We're going over everything you need to know about the Relative Strength Index or RSI indicator. Let's get started. Believe it or not, we can actually understand an important concept about how to use the RSI just by reading the name. Understanding this will come into play when we talk about divergences later as well. RSI stands for Relative Strength Index. So it's telling us the relative strength of the market. But what do we mean by relative strength? Let's start with the strength part. The strength is the momentum of the market in one direction. A lot of green candles one after the other would obviously have a lot of bullish or upward strength, and a lot of red candles in a row would have a lot of bearish or downward strength or momentum. Here's the key: the market doesn't always have the same level of strength. But first, we're going to have to understand a little more about how to use the RSI before we can understand why it matters that market strength varies. Looking at the RSI, we see an oscillating plot with stationary lines at the 70 and 30 points. The purple line is the relative strength index line. If you're using TradingView, there's automatically going to be a yellow line overlaid on the RSI line. We'll get to why that's important and what it does in a minute. But first, we're going to focus on the purple RSI line for now, so I'll just remove the yellow line. If you're not using TradingView for your RSI, that's fine, they all work the same. But you can use the link in the description to sign up for free or get $15 off any plan. Here's the basic overview. The RSI line moves up and down between 0 and 100. We have lines at the 70 and 30 point for a reason. But what does it mean for the RSI to be at any of these values? It's a little confusing in the beginning. Does 0 mean the market has 0 strength and 100 mean full strength? Well, not exactly. The line does tell us the strength, but it's directional, meaning it's not giving us how strong the market is. It's telling us what direction that strength is in. 0 wouldn't actually mean 0 strength. It means full bearish or downwards momentum, and 100 means full upwards or bullish momentum. You can think of 100 as 100% bullish movement, while 0 is 100% bearish movement. So a low RSI value like 20 or 30 indicates very strong momentum in the downwards direction, and a large value like 70 or 80 indicates very strong momentum in the upwards direction. The RSI basically never reaches 100 or 0 because you need to have only up or only down candles to reach it. But there's generally another line marked on the RSI. That's the 50 line. This is the actual 0 strength point. If we have equal up and down momentum, nothing moves, and we would sit at 50 on the indicator. It is the middle point between positive and negative strength. Anything below 50 and we have bearish strength. Anything above 50 and we have bullish strength. You might be thinking that we can use this to show us the general trend of the market, and that's actually a way to use the RSI we're going to talk about. But first, the most basic and common way to use the RSI is to use the 70 and 30 points to show us the overbought and oversold regions in the market. But what does it even mean for the market to be overbought or oversold? Think of it like this. The market has a certain amount of momentum it can expend in one direction before it starts turning and moving in the other direction. If the RSI line reaches 70 or above, it is considered to be overbought, and price is likely to return closer to the mean. At this point, it has been bought too much and the price has been driven too high, so it is expected to come down. It's the same when the RSI goes down below the 30 line. At this point, it's considered to be oversold and the price is likely to begin moving upwards again. This is the basic idea of the RSI. Price moves up and down between highs and lows, and the RSI aims to give you an idea at what point these highs and lows might occur. If we look at the RSI, you will see it can sometimes reach the overbought and oversold regions with almost no movement in the market, and then other times it takes a lot of large candles in one direction to reach these zones. Why does this happen? Now we can come back to the relative part of relative strength index. How much movement it takes to reach these overbought and oversold zones is determined based on the relative amount of momentum in the market. If price is barely moving, the RSI will be more sensitive to small movements, and if price is moving a lot, it will be less sensitive. Sometimes there's a lot of movement in between the highs and lows of the market, and other times there's very little. We still want the RSI to show us regions where the price could reverse in both of these situations. This is the relative part in relative strength index. It's not showing us the absolute amount of strength, since in different market conditions it takes different amounts of momentum to reach the highs and lows. But what happens when the RSI fails? When instead of price reversing when it reaches an overbought or oversold zone, it continues strongly in that direction. If you take a trade at this point counting on the reversal, your stop loss would be hit and you'd lose the trade. You've probably experienced this before if you've used the RSI. There's a couple of ways we can deal with this. First, let's go back to that yellow line that was originally on the RSI. This is simply a moving average of the RSI. We're able to set the length to whatever we want. We can use the yellow moving average line for additional confirmation that the price is actually reversing. Instead of trading when it hits the overbought or oversold zone, we wait until it crosses up or down through the moving average. The goal of this is to give more confirmation that price is actually reversing and momentum is changing direction. For sell positions, we would wait until price reached the overbought zone, and then wait for it to come down through the moving average. And it's the same for buy positions. Wait until the RSI reaches the oversold zone and then continue to wait until it crosses up through the moving average. Just be aware that it's possible to get into trades too late by doing this. Pay attention to what the market is doing and adjust accordingly. This strategy, of course, only works if the market is still ranging up and down to some extent. Of course, we can still have some level of trend, but it really works best when there is a strong cyclical structure in the market. What happens when the trend is too strong to ignore? This is where you can run into a lot of issues and losing trades. In an uptrend, the RSI will consistently hit the overbought region, yet price will continue in the upwards direction. It might come down slightly, but not enough for a successful trade. So how do we deal with this? Well, we can actually use the RSI to show us the general momentum of the market. This involves understanding changing the RSI length as well. First, we set the RSI to a much higher length. For this example, I'm going to use 150, but you can go higher or lower. We just want to significantly increase it from the default length of 14. Now we can use the 50 line of the RSI to show us the general momentum of the market. If the RSI is above the 50 line, we have an overall upwards momentum. If the RSI is below the 50 line, we have overall downwards momentum. This allows us to factor in the trend of the market. We only want to take trades in the direction of the current trend. Above 50, take long positions, and below 50, take short positions. You can use the moving average that we talked about earlier to filter signals a bit better. Instead of looking if the RSI is above or below 50, use the moving average instead. This smooths out the indicator if the market is noisy. Now, we don't necessarily want to enter a trade right when it crosses over the 50 line. To get better entries, I'm going to add a second RSI to our chart, but this one will have a lower length. In this case, I'm using 7. We use this RSI like I was talking about originally. This allows us to get entries in the ups and downs of the trend. If the moving average or RSI on the long length one is above 50, we look for buy positions. We wait until the short length RSI dips into the oversold zone for entries. This allows us more precise entries while also trading with the momentum. It's the opposite for sell positions. Wait until the long length RSI or moving average crosses below 50 and then wait for the short length RSI to move above the 70 line into the overbought zone. Just keep in mind, the market isn't always trending. If the long length RSI is just sitting crossing up and down around the 50 line, it will feel like you're always on the wrong side of a trade. This is when you want to trade the reversals of the market rather than trying to ride the momentum, because in this case, there is no momentum to continue onward. And of course, we can't forget about divergences. Understanding these can help us use the RSI even more effectively. Now, we're back to just the regular RSI with the default length of 14. Basically, divergences can show us when a reversal in price might be coming soon. A divergence occurs when price diverges from the RSI. Let me explain. Let's say price is continually making higher highs. When we look at the RSI, it is also continually making higher highs. This makes sense. The RSI is measuring the momentum of the market, and the market is increasing momentum to keep making higher highs. But this isn't always the case. Sometimes price makes a new high, but the RSI fails to. If we look back at the peaks of the RSI, we will see the new peak is noticeably lower than the previous ones, yet we've still made a new peak in price. This is a divergence. Price has diverged from the RSI. In this case, we're talking about a bearish divergence, meaning a reversal downwards could occur soon. Although the trend in price is continuing, momentum is slowing down. This could be a sign a direction change is in the near future. For a bullish divergence, we need the price to make a new low while the RSI fails to. A bullish divergence signals price could be coming near a bottom and might reverse upward soon. Luckily, TradingView has a built-in tool that helps us with seeing bullish and bearish divergences. If you're confused on if you're correctly identifying a divergence, this indicator can easily show and label them for you. In the TradingView indicator library, type in RSI divergence indicator and apply it to your chart. It's simply a regular RSI with the divergences labeled for you. It connects a line from the two peaks of the RSI and labels what type of divergence it is. Here we see a high on the RSI, and then a lower high on the RSI while price continued upward. This is marked as a bearish divergence. And here is a low on the RSI, followed by a lower low even though price continued downward. It's marked as a bullish divergence. In both of the cases, price reversed in the direction that the divergence indicated. Even if you aren't using divergences directly to trade in your strategy, it's important to be aware of them. You might want to think twice about trading in the current direction of the market when a divergence is spotted, even though it's possible that a reversal might not even occur. Keeping all the variables in mind is key to becoming a successful trader. There's actually way more than just one type of RSI. You might be familiar with the stochastic RSI. Check out my video on it if you want to know more. I also made a video on another type of RSI that tries to be even more effective than the regular one. I'll link both in the description. If you're interested in more advanced indicators, check out the Quantifica Patreon, where you can get access to the entire library of all current and future premium Quantifica indicators. Link in the description. If you found this video useful, a like would be greatly appreciated. If you want to see more videos like this, go ahead and subscribe. Thanks for watching.